We are in the middle of summer, although you wouldn't know it to look outside my window right now because at the time of recording this, it is absolutely pouring down. Not to mention the ongoing global situation, which has put a hold on lots of people's holidays and plans for the summer, doing things that we're used to doing. Nevertheless, I've got a summary stock for you today to brighten our moods, and this company is known as On the Beach. Now, On the Beach is one of the UK's leading retailers of beach holidays. They started back in 2004 and got listed on the London Stock Exchange in 2015. They now send away over 1.5 million people each year. Now, just like most companies in this travel and tourism sector, it has been hit hard due to the global situation. So let's see if at its current share price, On the Beach is a potential buy. If you find this video useful or interesting, or you just want to help me out, I appreciate if you hit the like and subscribe to my channel. I've also done a few other similar stock analysis on similar companies in this sector, so CCL, WIZZ Airlines, TUI, etc. I'll leave those in a link in the description below. You can check those ones out as well. So let's jump into the On the Beach stock. They say they have huge opportunities for growth and they're on a mission to become Europe's leading online retailer of beach holidays. And as you can see, their market cap currently sits at around about 464 million at the time of recording this. If we have a look at their share price here, we can see that it's currently trading at around about £2.86 per share. And it's obviously dropped off massively from where it was at a year. Just before the crash happened, it was trading at around about £4.32 there. And then obviously the crash has happened, just like most other companies in this sector, and it dropped all the way down to lows there of £1.40 per share. So it has obviously recovered somewhat, and it's now at £2.86. So it's a nice recovery, but it's obviously still quite far off of where it was trading. If we look at its 5-year graph, we can see that the growth in this has been quite good. This dates back all the way to 2015, where they was listed on the London Stock Exchange. As I say, this company's been around for quite a few years, but it only got listed in 2015. And the growth really did start to shoot up all the way from 2016 all the way up to 2018 here. It's hit all-time highs of £6.50 per share. And now, as we say, currently around about £2.80 odd per share. You know, it has been pretty stable from 2018 onwards, and obviously slight decrease there, but it has dropped off massively, and that's obviously to be expected with everything that's going on at the moment in the world. Obviously no one's booking holidays at the moment, so this company has been affected massively. If we look at their volatility compared to the market, obviously at the moment the industry is very high, and On the Beach is pretty much as high as it gets. It's up and down all the time. So this is, you wouldn't be investing this for a short term. This is definitely a long-term investment. We're not going to see a massive recovery in this anytime soon, that's for sure, until the holiday industry starts to pick up again. Now the price to book ratio here is 3.95, and we can see that it's actually considered overvalued by 2.1%. So it's not massively, it's kind of about right, slightly overvalued at the moment, with a fair value being £2.89 per share. I would talk about the PE ratio, however, On the Beach is currently unprofitable, hence there is no PE ratio for this one. But here's what we do like to see: the future growth. In the next 1 to 3 years, from 8 analysts here, estimates of 59.2% annual earnings growth, which is really good. And if we look at the forecast here, we can see obviously it has dropped off here in 2020, and there's predicted to be slight recovery here, and you can see here from September 30th in 2020, a slight recovery. So at the moment we are on negative earnings, and then it's predicted to slowly start going back up, and we'll be back to fairly nice earnings there. That's in 2024, with that slow increase over the next few years. By comparing the growth forecast for this company compared to the industry, we can see that it's almost double there. 59.2% is the forecasted growth for this company. As we know, this is forecasted, so it's not to say that it's definitely going to happen or not. However, it is almost double the industry and a lot more than the market. So there is a nice potential here with the forecast in this company. And if we look at the EPS growth forecast as well, it's also very good. We can see it's obviously been dropping off, and now we're at pretty much, huge lows here of
negative 0.16 earnings per share. But come 2022, the earnings per share is looking a lot more nicer and then slowly recovering back to where it was trading at pre-crash. As I said, this has been hit massively, and this is one for the future if you are going to invest. And if we look at the future return on equity, 25%. So just pretty much, in line with the industry. They're actually slightly beating the industry, and that is in the next 3 years. And we look at the past performance, obviously it has dropped off massively, but even with this drop off, we are still 8.8% up in the past 5 years. Now, the earnings and revenue, this company was actually doing very well. It had a very good profit margin. It was around about 14.6 there in January, and even slightly more, actually 18 in March last year. So the profits has changed ever so slightly, but obviously it's not currently making a profit, and we're actually down 22.1% profit margin. So that's not a great sign. However, if the worst is over, then this should be starting to see a nice upward trend. At the moment, obviously, there's no prediction for this, but at the moment, it is making a loss. And if we just speak about a point here from their earnings report, in April on the beach, this was April, obviously, right smack bang in the middle of the crash, really, or in the middle of this situation where nobody is traveling, there's a lot of uncertainty. On the beach, bookings were only at 10% of normal volumes, as holiday bookings obviously remained subdued. However, since then, in mid-June, there has been a significant increase in demand, obviously albeit still low levels. However, there has been a nice increase, and bookings for summer 2021 currently remain low, but significantly ahead of the previous year. So that is very good, and that's obviously due to, a lot of early release of flights are coming out for next year. They want to get those bookings in, and the bookings are significantly ahead of where they was. This is for summer 2021. Just going on to some of their financial health here, we can see the assets in this company do look quite good actually. They slightly outweigh the current liabilities short term, and the assets long term really do outweigh the liabilities short term, just 6 million. So that's very, very good actually. They're looking at that overview of their financial position. Going on to their debt to equity here. This company did actually have no debt, which is very rare from a company, but obviously most of this is based online, which is once again something that it does have going for it. Is an online company. It doesn't really have much overheads. So as we can see, 0% debt, but it has had to take on a fair bit of debt. It's currently 30% debt to equity ratio there, which actually isn't that bad. That's pretty good going, and I wouldn't be surprised if that debt starts to slowly come down and the equity to go up. Let's jump into their balance sheet, which is something that's very important here. We can see the main point here really is the cash currently sits at 17 million in cash and short-term investments, and we can see that physical assets 10 million, and obviously receivables, long-term assets. The debt there though is 30 million, so that they have obviously taken on a fair amount of debt, but that is not a lot really in comparison. And like I say, they've got the 17 million there in just cash and short-term, so they could pay off pretty much over half of that debt in one go if they really wanted to. Just to pick up with some of the earnings news actually coming out recently in their recent report. Obviously, the current global situation has affected this debt by quite a lot, but they have done a lot actually to reduce the amount of debt they've taken on and reduce the amount of spending. Just some of the things they did to respond to the global situation. They've reduced market costs to almost zero. Their monthly cash costs are now at less than 2 million across the group. So they're only having to spend 2 million a month, which is very low for a company with a market cap of about 460 million. They also took advantage of the job retention scheme to reduce the staff costs. That's obviously in the UK. A lot of people being furloughed, etc. And they still operate in a fully operational call center where you can book your holiday still, if so be it. And according to On the Beach as well, the CEO also forewent his salary, and the remainder of the board agreed to a 20% reduction in salary and fees. Also, no bonuses to be given out in this current financial year. And of course, if we move on here to the dividend, it's predicted to be 0.79, but that was also cut to protect costs, which is obviously probably the right thing to do, to be fair, for a company of this. You don't want to be paying out a dividend when they're not actually earning any money. So we do look at the dividend here though, just for future. It obviously dropped off pretty much from here of 0.033 per share of a 0.8% yield to 0%. And then it's predicted to go back up, and then even come around about 2023, a dividend yield of 1.2%. So it's not an amazing dividend paying company. Obviously at the moment it's cut, but in the future, there is that slight added bonus there of a dividend potentially being reinstated. One thing that I do really like to see with this company actually is insider trading. And as you can see here, in the last 0 to 3 months, about 1.1 million pounds worth of shares has been bought, totaling to 419,000. And if we actually go into some details of this, you can see here this majority of that was actually bought by Simon Cooper. He bought £1 million worth of shares, which was 388,350 at a total of £2.58. And he is actually, Simon Cooper is actually the CEO of this company. So if the CEO is buying shares in this company, that is very promising. You want the board to have faith in this company and the direction, and that's what they're doing. If you look at all of these people here, a lot of these are actually involved in this company. As you can see, they all bought on the 27th of May. So maybe there was a big meeting that day and they discussed potential plans going forward, and maybe it inspired them all to invest or something. But if we look here at the top shareholders, Simon Cooper there owns 7.45% of this company, and obviously he's still adding to that position as well. So as a whole here, I do think, there's a lot of upside potential. It's in a very risky sector, as we know, but this is an online company, and at the moment, we've got insiders trading. Their debt to equity isn't that bad, and also they've reduced a lot of costs. They're not spending out a massive amount each month. It's just whether the bookings are obviously starting to see an increase, and if they continue to increase in the next quarter, that will be very interesting as well.
So it's no surprise that this company is struggling at the moment and they are currently unprofitable. Now, they do have huge upside and huge potential growth though in the next few years. And unlike other companies in its sector, it doesn't have huge overheads and it doesn't have huge debt, and that is because it is based online, which is something that I really do like about them. People are always going to want to go on holiday, they're always going to want to travel. Now, this company has been growing over the years and it's still fairly new compared to lots of others in this industry. So I do think there's lots of potential with this one. Now, obviously, they are in a sector that is really struggling at the moment. It has been hit hard and it's going to take some time to recover. So we do have to take that into account. Let me know down in the comments below, have you heard of On the Beach before? Is this a company that you maybe hold shares in or considering it? Also, let me know if you want me to cover any other stock, do an analysis on one of those. I'm open to any suggestions. So thanks for watching, and if you hit the like and subscribe to my channel, that is really appreciated. Until next time.